I have enormous respect for what George is doing with the Ben Graham Center, and it's a particular thrill for me. You know, Michael talked earlier about temperament and some of the characteristics of investors, value investors, and one of the things I found is that value investors have a spirit of friendship and kinship and generosity, and so it's a real thrill for me to be on the same panel with Tom Russo. Tom and I go back well over 20 years, and it would take me the whole day to describe the many ways in which Tom Russo has been helpful to me. So he's just he's an amazing investor and a great guy, and so it's just a real thrill for me to be on the same panel with Tom. So with all that said, I thought I'd go in a bit different direction to what some of the other speakers have talked about. Yes, we're long-term investors just like everyone else. We tend to run concentrated portfolios, but I thought I'd spend some time on what I will describe as an underappreciated value investing technique. And so what is this underappreciated value investing technique? It's event-driven investing. And let me start by dispelling a little bit some confusion around labels and titles. Event-driven investing, arbitrage, workouts, risk arbitrage, it's all the same thing. And, you know, Ben Graham was writing about this in the original securities analysis text, Arbitrage Opportunities. Warren Buffett did it for years. I also am going to put a plug in for Michael's book. Go out and buy it. It's available on Amazon.com. The chapter on Lou Simpson is worth it. The price of the whole book. I've been a big Lou Simpson fan. And one of the things I didn't know until I read Michael's book is that Lou Simpson also did a lot of arbitrage over the years. So I guess I'm just trying to set this up for you that even though it's a different activity and it's more short-term in nature than what we spend most of our time doing, it is definitely part of the value investing craft. And so let me try and take you through it. By the way, I'm going to refer to it as event-driven investments. Throughout my career, I've used all those labels on the prior page to describe what we do, but it seems that at the moment, event-driven investing seems to be the popular way to describe this activity. So what is it? Pursuit of profits from announced corporate events. And so things like mergers, recapitalizations, spin-offs, liquidations, reorganizations, self-tender offers, any of these things can be a event-driven investment opportunity. Now, just you saw in the earlier bullet, I said announced corporate events. I just want to clear something up right from the get-go. We're not trying to guess what the next takeover company is. You know, Buffett used to use the phrase, we just read the papers like everybody else, and you know, that's certainly the category. We're only looking at announced corporate events. And you evaluate these opportunities by asking 4 questions, and I'm going to flesh that out in a bit by sharing a quote from Buffett himself. But basically, it's what's the probability of this event happening? How long is our money going to be tied up? What's the probability that something still better can happen? Competing takeover bid would be the obvious one. And then what's the downside if something goes wrong? And you know, we'll talk later about the many downsides that can reach up and bite you in event-driven investing. And the key to this is that we expect a profit regardless of the behavior of the stock market in most circumstances. So if you do it right and you successfully appraise the probabilities correctly, you should profit whether the market's up or down over that period of time, because it's a discrete corporate event. Whether company A succeeds in taking over company B has absolutely nothing to do with whether the market's up or down 1,000 points. So I'm going to borrow from Warren Buffett at different points in his career, and I just think there's going to be some wordy quotes come up here, but I just think it's important to set the backdrop, and so I apologize for the wordiness on the screen, but in his 1962 Buffett partnership letter, he had the following to say, and at that time he was calling it workouts, so just back to this labeling issue. So these are securities whose financial results depend on corporate action rather than supply and demand factors created by buyers and sellers of securities. In other words, they are securities with a timetable where we can predict within reasonable error limits when we will get how much and what might upset the apple cart. And as I alluded to a moment ago, corporate events such as mergers, liquidations, reorganizations, spin-offs, etc. lead to workouts. So that's Warren Buffett in 1962. Let's also take a Buffett quote, a couple of Buffett quotes from his Berkshire Hathaway days. So this is the 1988 letter to shareholders. And again, I apologize for the wordiness, but I'm just going to read it because I think it's appropriate to get these concepts out on the table. Since World War I, the definition of arbitrage, or risk arbitrage, as it is now sometimes called, notice the shift from workouts to arbitrage to risk arbitrage, has expanded to include the pursuit of profits from an announced corporate event such as the sale of the company, merger, recapitalization, reorganization, liquidation, self-tender, etc. In most cases, the arbitrager expects to profit regardless of the behavior of the stock market. The major risk he usually faces is that the announced corporate event won't happen. So that's Buffett in 1988. And then same letter. This is actually the 4 questions. And you know, I didn't invent any of this stuff. We have a long heritage going back to Ben Graham and Warren. So this is the 4 questions that I talked about earlier. To evaluate arbitrage situations, you must answer 4 questions. How likely is it that the promised event will indeed occur? How long will your money be tied up? What chance is there that something still better will transpire, a competing takeover bid, for example? And 4th, what will happen if the event does not take place because of antitrust action, financing glitches, etc. So just trying to set the table for you, if you will, about what this is all about. And so then what I'm going to do for the rest of my presentation is take you through 2 case studies of 2 arbitrage situations, 2 event-driven situations. And you know, the problem when you're an arbitrageur, I need to give you one that's been completed so you can understand the math and how much we made on it. But of course, then people say, well, you know, Stacey, you cherry-picked your example. And so now I'm going to also give you one that's currently in progress and lay out for you what we think we might make. And if it works out successfully, I'll come back in a year, George, and reprise it. If it doesn't, you know, we'll just bury it as quickly as we can. So first example, Berkshire Hathaway taking over Precision Castparts. Now, let me say, normally Berkshire Hathaway transactions are not a good source of arbitrage activities because the spread is so tight. It's hard to make a decent rate of return because he's a high quality, Berkshire Hathaway's a high quality buyer. To the best of my knowledge, they've never failed to close on a transaction. I stand to be corrected on that, but I believe they've never failed to close on a transaction. So let's talk about the transaction details. There was a definitive agreement by Berkshire Hathaway to acquire Precision Castparts, and that was announced on August 10th, 2015. The terms of the deal were $235 per share in cash. Quarterly dividends were being maintained until closing. It was only a 3-cent a quarter dividend, so it's almost immaterial in this transaction, but I certainly, you know, sometimes that's a key part of driving the return. If you can capture a disproportionate amount of dividends because of the timing, that sort of thing. But for the record, quarterly dividends maintained until closing. There was no financing condition. And That's a big risk reducer. Oftentimes companies will make a bid for something, but it's dependent on financing. That increases the risk dramatically. In this case, there was no financing condition, and Buffett had $40 billion in cash on the Berkshire balance sheet at the time to close the transaction. You always have regulatory approvals. Some are industry specific, but most often it's anti-competitive issues. So you had what's called Hart-Scott-Rodino Act approval in the United States was required, and there were a number of other foreign clearances, including the EU, Canada, China, France, Turkey, and the Ukraine. This transaction also required Precision Castparts shareholder approval. Fairly typical thing, but that's also something you want to think about, and what was the price, and will shareholders vote for it, is there a controlling shareholder that might not be in favor of the transaction, what have you. And the expected closing, both companies in their initial press release said the expected closing was the first quarter of 2016. And sometimes these things drag on, sometimes they close quicker, but that was the date that they gave in the initial press release. So what were the things that I was thinking about as I was looking at this investment? What were the key considerations? Well, certainly Berkshire's track record for closing. I mean, as I said earlier, I don't believe they've ever failed to close on something that they had a definitive agreement to purchase. No financing condition. He had the cash. That's a big risk reducer. It was a premium price. The stock had traded a little bit higher at one point over the prior 2 years to the deal being announced, but it was on the upper end of the price to be received. So that's always something, that will in turn get you shareholder approval if it's a premium price. Before we purchased any shares, HSR Act approval was already received. So it was received on October 5th, 2015. Sorry, I should maybe just interject. We did not initially purchase shares because the spread was only, 4% annualized and tight, as you would expect from a Berkshire deal, because it's a high quality transaction. But we monitor these things, and sometimes you get opportunities along the way, and so you'll see in a moment when we first purchased shares. But for the record, the first anti-competitive clearance from the United States was in on October 5th. Shareholder approval was received on the 19th of November, so they had the proxy out, and shareholders voted on it on the 19th of November. And the remaining foreign clearances at that point seemed pretty routine. And a couple of them were in, but there were a few that were lagging on. So let me just take you through the whole timeline here. So again, the transaction was announced in October. The waiting period on HSR Act expired October 5th. October 10th, the definitive proxy statement came out. That's an important thing when that definitive proxy statement comes out, because it has all the details of the transaction, and you've got to go through that and make sure there's not any wrinkles that you failed to pick up. So we purchased our first shares on November 9th. So after the proxy statement's out, but before the shareholder meeting, we had a pretty high degree of confidence that the shareholders would approve the transaction. Shareholder approval came through on the 19th. Canada Competition Act approval came through in December. Just a point of clarification, you never know the exact date. I've put it as the middle of December. They just give you the monthly clearances at the end of the month, so it might have been the 15th, it might have been the 1st, it might have been the 30th, but just a point of clarification there. So then early in 2016, we purchased additional shares on the 14th of January. And let me paint the scene here. If you'll recall, markets were quite weak in the early part of 2016 in January and February. And so again, this notion that arbitrage situations or event-driven situations aren't influenced by the market. The shares hadn't budged But now the time frame had condensed because they expected to close in the first quarter of 2016. But, you know, the share price hadn't gone down at all in a very difficult time in markets generally. So we purchased more shares. We purchased more shares again on the 20th. And the final regulatory approvals were received on the 25th. And the transaction closed on the 29th, and we received our funds in early February. And that's pretty typical. There's a, you know, often up to a week delay in getting your funds from these transactions. So let me take you through what the return actually was on this transaction. And I've done this, you know, we run 2 funds and a separate account and at our firm, so I've done this on a per share basis, but this was the actual returns that we received. So $235, we got 2 cents in dividends, and that's just because part of our purchase received the 3-cent quarterly dividend, but the other part was after the last dividend period, so it worked out to 1.8 cents or 2 cents. So $235.02. We paid $231.20, made $3.82. Not a big spread, you know, it was a 1.65% spread. Closing date was January 29th, but our weighted average holding period on those 3 purchases was 54 days. Or it was an annualized rate of return of 11.17% or 11.2%. You know, I joked with our clients at the time, in my mind, you know, a Berkshire Hathaway transaction is safer than U.S. government treasury bills. But at the time, U.S. government treasury bills were yielding basically 0 to, you know, 0.25%. We're getting 11% annualized from that transaction. So that's an actual one that we did. Those are the returns we generated. Let's fast forward to one now and do a second case study where it hasn't yet closed. Johnson & Johnson is buying a Swiss pharmaceutical company called Actelion. So let me run you through the basic details of the transaction. Definitive agreement announced on January 26th this year. The terms of the transaction were $280 US per share and 1 new share in an R&D company. So Johnson & Johnson didn't buy all of Actelion. Their early stage pipeline will be spun off into this company to be called Idorsia. Terms were minimum acceptance condition of, you know, 2/3. That's fairly typical. Competition clearances, again, US, Europe, Japan, Russia, Israel, and Turkey were the main ones required. In most transactions, there's what's called a material adverse event clause, what would give Johnson & Johnson the right to walk from the transaction. So in this case, they had set 15% of EBIT, earnings before interest and taxes, or 10% of sales based on the 2015 year for Actelion, because their 2016 results were not yet out. So companies both announced expected closing late second quarter 2017. I'm using, and you'll see in our math later, I'm using June 15th as a closing date. So what are the key considerations? Like the Berkshire deal, no financing condition, and, you know, Johnson & Johnson had $30 billion sitting in Switzerland in a bank account ready to close this transaction. So, you know, financing's not an issue. Premium price. This was an all-time high. The CEO, Jean-Paul Clozel, had agreed to tender his shares to Johnson & Johnson in the transaction. He owned just under 5%. And interestingly, he's going to go with the spin-off company as the CEO, and we'll talk more to that in a moment. That's a key consideration in this. This was well shopped before you had a final agreement. And, you know, Santa Fe was certainly widely documented in the press as having an interest, and they backed out at the last minute. And I only say that because that can be a risk reducer for whatever reason. If Johnson & Johnson walked from the transaction, perhaps you'd have some of these other underbidders back in the fray. Now, you might take less money, but at least it's a risk reducer in the sense that you're not looking at a complete black eye if the deal doesn't close for whatever reason. So the other thing, of course, we were thinking about was like what would be a fair value on this new R&D company, and they disclosed the various drugs that they're working on. I will readily concede I have no particular expertise in that, but we had a couple of data points that I think gave you a sense of where this new company might trade in the marketplace or what its opening valuation would be. J&J agreed to put 235 million Swiss francs in to the new R&D company for a 16% interest. Well, if you just do the math, was about 11.50 a share. So that's what J&J's paying for their interest in this company. Not saying that's fair value or where it'll trade, but it just seemed like a reference point that made some sense. The other thing, there was going to be 1 billion Swiss francs in total in cash put into the new R&D company. Of course, they're going to burn that cash over time, bringing these early stage pipeline products to market. But day one after the transaction closes, there'll be 8 Swiss francs a share. So you got 2 data points there, 11.50 and 8. And of course, what was the value of this early stage pipeline? And as I said, I don't have any particular expertise in evaluating that, but it certainly appears like they have some promising compounds, drug compounds, and drugs. So in this case, as you'll see in a moment when we go through the math, there was actually a fairly significant spread. And why was that? Well, after the deal was announced, the French medical regulators came out with a letter where they asked doctors in France to stop prescribing one of Actelion's drugs, Arbitrage, to new patients. They didn't issue a ban. They said doctors could continue to issue the product to existing patients that were using the product. So I think investors got a little concerned that maybe this was going to lead to a material adverse event. And interestingly enough, the Arbitrage sales for 2015 were basically what the 10% sales level was. And so if you had a worldwide ban on Arbitrage, this could be a problem for this deal. So not trying to minimize that. That was certainly something that we were thinking about and trying to get a sense of. But I should point out, Johnson & Johnson came out and said, we were fully aware of the actions that the French medical regulators were going to take before we made our bid, and we don't see it as a problem. Okay, you can take that for what it's worth, but clearly it seemed like Johnson & Johnson was committed to the transaction. Yeah. So run you through the timeline. Again, transaction announced January 26th. We purchased shares on the 30th. We purchased shares on the 1st. The public tender offer prospectus in Switzerland was issued on February 16th. There was a lot of details in there about the transaction. We purchased more shares on March 27th. The end of the first tender offer period, in Switzerland they have dual tender offer periods. So the first period ended March 30th. On the 31st, Johnson & Johnson declared the tender offer successful. Now that doesn't mean it's going to close because you still have regulatory approvals to get, but they were over the 2/3 minimum tender condition was satisfied during the first tender period. So if all the other conditions line up, they declared it a successful tender and they will go ahead. On the 31st, it was also announced that US approval, Japanese approval, Israeli approval was in. So a few more to go, but we're a good way along the approval process at this point. And then the general meeting of Actelion was held on April 5th to approve the demerger. So the demerger is just the spin-off of Idorsia, the new R&D company that you're going to get when the transaction closes, and that was successful. April 20th, which I guess is tomorrow, I think, will be the end of the second tender offer acceptance period. And then, you should go to closing after that. And, again, we're just using June 15th. I actually think it might be quicker than that, but in the interest of conservatism, June 15th, and that's the day you'll get your 280 USD, and that's the day you'll get your Idorsia shares if this transaction closes. So let's go through what's now expected return, because we're not to the finish line yet. So I've adjusted all the figures to Swiss francs based on the March 31st exchange rate. So the 280 US is actually 280.42 in Swiss francs, and I'm valuing the R&D company at 10 Swiss francs a share. Remember our data points, 8 in cash, 11.50 is what Johnson & Johnson paid for it. I'm not saying that's where it's going to trade. It may be lower, it may be higher, but I'm trying to just choose a number that I think is realistic in terms of getting the return. So you'd get 290.42. By the way, we will be thinking a lot about the spin-off, and do we want to continue to hold it? One of the things I'm very intrigued about is that the CEO of Actelion has gone to the new company, and he may he's getting $1.5 billion in cash out of this transaction from his shares in Actelion. It wouldn't surprise me if he doubled down. I think a lot of the shareholders may double down because this has been such a huge success story. Actelion has been such a huge success story. I think a lot of investors may double down and say, let's try it again. This guy's a winner. So that's kind of one of the things that I'm thinking about here. So the price we paid all in over those three series of purchases was $270.99. Our gross profit's $19.43 if we sell the stub at 10 Swiss francs. Closing, so 7% spread, closing date June 15th. Our weighted average holding period was 108 days. So if that is how this transaction gets to the finish line, we will have a return of annualized rate of return of 24.23%. So as I say, it's on the come. I don't know how it'll work out. I do think it actually will close sooner than June 15th based on how things are going. I know, Tony, you had a long career in M&A, and you know how getting all these approvals and getting everything, it just takes time. But it would appear to me that they're ahead of schedule to what they said. So those are the returns. So just trying to give you a flavor for what I labeled at the start as an underappreciated value investing technique. Lou Simpson did this, Warren Buffett does this, Ben Graham did this back in the 30s. So let me wrap up and just talk, what do I see as the benefits? Well, returns depend on transaction completion and not on movements in equity markets. Most transactions are uncorrelated with each other. Whether Actelion happens or doesn't happen has nothing to do with whether Syngenta gets taken over by ChemChina, another transaction that's on the go. Short completion times lead to cash availability, and so I like this aspect of it. If markets corrected a lot and we found ourselves with lots of things to do on the long-term investment front, we're going to be constantly getting cash back from these arbitrage situations. Multi-strategy benefits, I just like this idea that you have another page in your investment playbook. Behaviorally, one of the things that we all struggle with as investors is you think you have discipline, but you can't find things to do among your long-term investment front, and you don't realize it's happening, but you're going down your discipline spectrum and saying, well, you know, this is okay, and you know, I can't find things to do, but this is okay, and then behaviorally you talk yourself into doing something. So that's what I like about this, a second page in your playbook. Good information availability and transparency. All I mean is that all the details are in the documents. If you read the documents, you can get an understanding of what's going on in these transactions. Risks. Of course, transactions can break for many reasons. Financing issues, shareholder rejection, regulatory concerns, antitrust approvals, material adverse event. And you know, when a transaction breaks, it is a black eye, or it can be a black eye. So you need to really be cognizant of transactions and why they might break. Any single transaction is a binary event. Either it happens or it doesn't happen. You know, Michael was talking about the Kelly formula. You know, you can have a 95% probability, a 98% probability that a transaction is going to happen. But somewhere along the way, you're going to be at the table and be in that 2% camp. So, you know, transactions, anyone is a yes or no. It may or may not happen. And so a good batting average is absolutely essential in these transactions. So very quickly, that's my presentation. I thank you very much and happy to take your questions later.